A sudden escalation in the Middle East tensions following the US and Israeli strikes on Iran has sent shockwaves through the Asia-Pacific markets. The effective closure of the Strait of Hormuz, which is responsible for 20% of the global oil flows, has triggered a classic risk of rotation. The equity markets are plunging, regional currencies are weakening against a surging US dollar, and the Brent crude has spiked 15% to approximately 81 per barrel. South Korea's Kospi is experiencing its worst two-day decline since the 2008 financial crisis. Japan's Nikkei and Australia's ASX 200 are logging multi-week lows. Central banks across the regions are in a wait-and-watch mode as markets digest the implications of inflation, growth, and monetary policy. Hello everyone, welcome back to our channel and welcome back to this important update video. We are seeing Kospi, Nikkei, ASX, and SGD, that is the Asian markets, in a crisis mode. The Iran conflict triggers Kospi's worst crash since 2008, sends Nikkei to one-month low, and weakens the regional currencies. Let's do a deep dive and let's try and understand what's happening. Let's start with the catalyst, which is the escalation of the Iran conflict. Now, over the weekend, reports emerged of coordinated US and Israeli military strikes on Iranian targets. The Iranian response followed swiftly, with retaliatory strikes reported across the Gulf region and the conflict spreading to Lebanon. The rapid escalation has effectively closed the Strait of Hormuz, a critical choke point through which approximately one-fifth of the global crude oil transits daily. The immediate market reaction has been a textbook risk-off, a flight to safe haven assets, aggressive US dollar buying, and a sharp sell-off in equities across the region. Brent crude prices surged 15% in a single week, briefly touching 85 per barrel before settling at around 81 per barrel. The US dollar index approached the psychologically significant 100 level, reflecting both its safe haven appeal and the market expectations that higher oil prices could reduce the probability of a Federal Reserve rate cuts this year. Next, let's do a deep dive with respect to the respective markets. Let's start with South Korea, wherein we are seeing a historic sell-off that is unwinding the AI boom. The South Korean equities have borne the brunt of the sell-off. The Kospi index plunged 8.1% on Wednesday following a 7.2% decline in the previous session, marking the index's worst two-day performance since 2008 global financial crisis. Trading in both Kospi and Kosdaq shares was suspended for 20 minutes after the indices fell 8%. The severity of the decline reflects both the magnitude of the prior gains and Korea's vulnerability to the energy shocks. The Kospi has risen nearly 50% year-to-date at its peak, driven by insatiable global demand for memory chips and an AI-fueled rally in semiconductor heavyweights. As the world's eighth largest crude importer, South Korea faces a direct hit from the elevated oil prices. The market participants are divided on whether this marks a turning point or merely a correction within the ongoing bull market. The foreign funds were net sellers during the morning trading, while domestic retail and institutional investors added positions, suggesting some opportunity amid the chaos. However, what we are also seeing is that defense stocks have bucked the trend and they have rallied more than 25% as investors have bet on sustained regional instability. Next, let's move on to Japan and see how Nikkei has retreated to one-month lows. Japan's Nikkei 225 fell 3.5% to 54,340 at its lowest level since early February and the third consecutive session of losses. The broader topics declined 3.68% and chip-related heavyweights led the decline, with Advantex and Tokyo Electron each falling nearly 5%, while the technology investor SoftBank Group lost 6.89%. All 33 of the industry sub-indices declined, with oil refiners falling 7.65% as the worst performing sector. Investors appear to be taking profits in market that had outperformed peers, with both Nikkei and Kospi becoming the targets for heavier selling. The software-related shares, however, saw selective buying, mirroring the overnight gains in the US peers such as Salesforce, with Baker jumping 5.75% and Shift gaining 1.84%. Moving on to Australia, we saw rate hike fears compound the sell-off. Now, Australian shares faced double headwind. The S&P ASX 200 slid 2.2% to 8,882, its lowest level in 3 weeks, and is on track to be the biggest weekly decline since April of last year. Beyond the geopolitical concerns, data released on Wednesday showed that the Australian economy expanded at its fastest annual pace in nearly 3 years during the December quarter. This surprising strong growth reading has rekindled inflation concerns and reinforced expectations that interest rates may need to rise to cool the momentum. Now, while Australia is a net energy exporter, sustained oil price increases act as a tax on consumers and businesses, complicating the monetary policy outlook. Moving on to Singapore, we are seeing relative resilience and regional stress. The Singapore dollar weakened 1.1% against the US dollar over 5 days, trading at 0.7824 on Wednesday. The benchmark equity index declined 1.6% for the week. And as a highly trade-dependent economy reliant on energy imports, Singapore faces potential pressure from higher electricity, transport fuel, and shipping costs. DBS estimates roughly 7% of Singapore's consumer price index basket would be directly impacted by sustained energy spike. However, we also have to stress that the Singaporean economy enters the period of uncertainty from a relatively strong position, supported by strong growth momentum from global AI-related tailwinds and still low inflation at the start of 2026. The Singapore dollar's traditional safe haven characteristics may also provide some relative resilience compared to the regional peers. And finally, let's talk about the central bank response, which is more of a wait and watch approach. The regional banks appear to be adopting a cautious stance. The DBS analysts note that the policymakers are unlikely to act preemptively on monetary policy, preferring to remain on hold while monitoring domestic currency and the bond yield movements. For Singapore, a sustained Brent crude spike could complicate Monetary Authority of Singapore's policy bias towards earlier frightening. Some stabilizing factors have emerged. Washington announced that it would provide war risk insurance through the U.S. International Development Financial Cooperation for ships transitioning through the Strait of Hormuz. Additionally, China's decision to set stronger than expected daily fixing for the yuan, the People's Bank of China lowered daily fixing by 148 pips to 69,088, its largest adjustment in over 6 months, and it has helped anchor the regional currency stability for now. Let's wrap up this brief and important update with the investment implications. For investors, the current environment presents both risk and selective opportunities. The aggressive flight to the US dollar safety appears overstretched after testing resistance near the psychological 100 level on the DXY, prompting some investors to dial back long positions as the initial shock begins to digest. Defense and shipbuilding sectors are emerging as potential beneficiaries of prolonged instability, with South Korea defense names already seeing significant gains. The key variables to monitor include the trajectory of the Brent crude prices, any diplomatic developments regarding the Strait of Hormuz, Federal Reserve communication on inflation implications of the energy shock, and the regional central bank responses. In short, the markets are pricing the worst-case scenario, and any de-escalation could trigger a relief rally, while further escalation would deepen the risk of rotation. Now that's what we wanted to share with you in this update. Hope you have found this insightful. Stay tuned in for our next one.